Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories in corporate filings. And tonight we're diving deep into the financial heart of T. Rowe, Prices Limited Duration Inflation, Focused Bond Fund. Its latest report is out, and while it might sound a bit dry, trust me, there is a lot more going on than just numbers. Before we jump into the meat of this financial feast, if you appreciate us breaking down these complex reports into plain English, hit that subscribe button and ring the bell so you never miss a video. And hey, if you are into connecting with fellow finance enthusiasts and asking us your burning questions, join our Discord community. Also linked in the description below. So what exactly is this filing all about? Well, this is a semi-annual shareholder report for the T. Rowe Price Limited Duration Inflation Focused Bond Fund, and it covers the period up to the 30th of November 2025. Think of it as a mid-year check. Up for this investment fund, giving us a clear snapshot of its performance, its investments, and its financial health. Now, the fund offers different classes of shares, and for the investor class, which is what many people might hold the costs for a hypothetical $10,000 investment over the last 6 months, were around $26. That translates to about 0.52% of the investment. Not too bad, but it is always good to see how these fees stack up. Let's talk big money. The fund's total net assets are a staggering $898.7 million. That is almost $9 billion under management. That tells you this is a significant player in the investment world, and a lot of people are trusting this fund with their money. And what are they investing in? Well, they hold about 52 different investments. One of the most important things to note here is the portfolio turnover rate, which is 16.8%. This means they are not actively buying and selling a lot of assets. They seem to be holding onto their investments for a good chunk of time, which can often mean a more stable and less costly strategy. Let's see where the money is going. A whopping 99.9% of the fund's assets are invested in US government agency obligations excluding mortgage, backed securities. That is a massive concentration in a single asset class. And when you drill down into that, the top holding by a landslide is US Treasury inflation, index notes making up 95.9% of the net assets. This is a very clear signal that the fund's strategy is heavily focused on protecting investors from inflation by tying its investments to the consumer price index. The next highest holding is US Treasury inflation, index bonds at 4.0%, so it is pretty clear what this fund is all about, keeping pace with inflation. Now let's look at the costs across the different share classes. For the investor class, it was $26 on a $10,000 investment. For the I class, a bit lower at $15 with a 0.30% cost. And for the Z class, which is typically for institutional investors or those with very large accounts, the cost was $0. Zip, nada, that is a huge perk for those investors. Interestingly, it's interesting to note that despite these different cost structures, the total net assets remain the same across all classes at a massive $8,987 million. This means the overall size and value of the fund is consistent no matter which class you are in. And that portfolio turnover rate remains a steady 16.8% across the board. This reinforces the idea that these share classes are all managed under the same investment strategy. The investment allocation also stays consistent, nearly all of it 99.9% in US government agency obligations, and the top holding remains US Treasury inflation, indexed notes at 95.9%. It appears the fund's core strategy is very firmly in place for all investor classes. Now let's dig into the financial highlights for a share outstanding throughout each period. For the investor class, the net asset value, or NAV, per S-Share at the beginning of the period was $4.80 and it ended at $4.73. This shows a slight decrease in the value per S-Share over the 6 months. For the I class, the beginning NAV was $4.76 and it ended at $4.69. Also a slight decrease. And for the Z class, the beginning NAV was $4.74 and it ended at $4.67, again a slight dip. It is important to remember that net asset value per S-Share can fluctuate based on market conditions and the performance of the underlying investments. Looking at total return for the investor class for the 6 months, it was 2.29%. The I class saw a slightly better 2.40% and the Z class performed the best with a 2.54% total return. This shows that even with the same underlying investments, the fees charged by each class can impact the overall return to the investor. The Z class, with its zero expense ratio, unsurprisingly delivered the highest return. And speaking of expenses, for the investor class, the net expenses after waivers were 0.52%. For the I class, it was 0.30%. And for the Z class, a remarkable 0.00%. This clearly illustrates the benefit of lower expense ratios for investors. Now let's get into the nitty-gritty of the actual investments. As we saw, the fund is heavily loaded into US Treasury inflation. Index notes with a massive $8.976 billion invested in these. A significant portion of these particular notes, the 10 divided by 15 divided by 26 maturity, are noted as being pledged as collateral and/or margin deposit to cover future funding obligations. This means a part of their holdings is essentially earmarked for other financial agreements. They are also using derivative instruments like inflation swaps. For example, there are several 2-year zero coupon inflation swaps. These agreements are designed to exchange cash flows based on the difference between a fixed interest rate and the change in the consumer price index. Essentially, they are betting on or hedging against inflation. For instance, one of these swaps has a fixed component of 2.800% at maturity, and they receive the variable change in CPI. They also engage in futures contracts. They have long positions in US Treasury notes 5-year contracts. These are essentially agreements to buy Treasury notes at a specific price on a future date. This can be used to manage interest rate risk or to speculate on interest rate movements. The fund has a total of about $1.3 million in centrally cleared swaps liabilities. And on the asset side for futures contracts, they have about $63,000 in value with unrealized gains. Looking at the statement of operations for the 6 months ending the 30th of November 2025, the fund generated $221 million in total income, primarily from interest. Expenses were around $1.875 million. Interestingly, the investment management fee was a substantial $15.1 million. However, a significant portion of this was effectively waived or paid by T. Rowe Price Associates to manage the net expenses. This resulted in a net investment income of $219 million for the period. In terms of realized and unrealized gains and losses, the fund had a net realized gain of about $2.9 million from securities and futures. However, there was a change in net unrealized loss of about $1.6 million, primarily from swaps, further impacting the overall gain. So the total increase in net assets from operations for this period was a very healthy $220 million. Now let's bring it all together. What is the story here? This fund is laser focused on one thing: beating inflation by investing almost exclusively in US Treasury inflation indexed securities. This is a relatively conservative strategy aiming for stability and protection against rising prices. The huge concentration in these assets shows a strong conviction in this approach. The different share classes highlight the impact of fees. The Z class with its zero expense ratio is clearly the most cost effective option, benefiting from the economies of scale and the fund manager's willingness to absorb costs. For investors in the investor and I classes, however, a portion of their returns is eaten up by fees, although the fund manager does provide significant waivers to keep those costs down, especially for the I class. The use of derivatives like inflation swaps and futures contracts shows they are actively managing risk and potentially trying to enhance returns beyond just holding the bonds. It adds a layer of complexity, but it is a common practice for sophisticated bond funds to navigate market volatility. Overall, Rowe Price Limited Duration Inflation focused bond fund appears to be executing its stated strategy effectively by providing a stable inflation, hedged investment primarily through US Treasury inflation indexed securities. The fund's massive asset base gives it significant leverage and potentially lower operating costs per dollar managed. The key takeaway for any investor considering this fund is to understand the impact of fees associated with their specific share class and to be comfortable with a highly concentrated portfolio focused on inflation protection. This is not a fund for aggressive growth, but rather for capital preservation against the eroding power of inflation. Alright, that is our breakdown of the T. Rowe Price Limited Duration, inflation-focused bond fund's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.